And now, broadcasting from Titletown, USA, here's Joe Simon.
Well, welcome. We are excited about the subject matter. Today, we've got a subject matter expert joining us today. I'm Joe Simon. This is the Joe Simon podcast, where what we try to do is educate, inform, ask really great questions as we come to this subject matter called financial strategies. And that's what the show is about today. A quick 30 minutes. We're going to be looking at a lot of different things, a lot of things happening in the prep leading up to the show in just the last 5 or 6 days. A recent nationwide financial survey just came out. Interesting facts, and I'm going to just pick on a couple of those. Majority of the survey says that people are concerned about their retirement. Retirement confidence level is at an all-time low, except from those who say they have an annuity. Why? Why is this? Number two, why are Americans ages 45 to 60 delaying their retirement? Now showing that the target age is 64.3 years. That is up from 2023 by about 6 months. So people are waiting 6 months longer in this particular case. And here's the final thought as we get into today's thoughts and strategies. Do you have this? Do you have the fear of outliving your retirement money, outliving your retirement assets? It's a real concern. It's due to anxiety, concerns with the talk around Social Security, possibly inflation. Is that you? 70% of Americans from the Allianz survey, that's over 15 years old now, continue to say that 66 to 71% zone. They're concerned about outliving their retirement income, living too long. Well, what we want to do right now is welcome in today's guest, Scott White. I call him an annuity mastermind. Scott's behind our scenes, an analyst on all things annuities, working with over 20 insurance carriers and the latest annuity designs. Welcome in, Scott.
Yeah, thanks for having me, Joe. Appreciate the time today.
Hey, Scott, let me ask you, what is it about these things called annuities? Is it the multi-year guarantees that we hear about, but frankly, a lot of people don't quite understand what a multi-year annuity is. Is that like multiple annuities and expiring over a certain period of time? Another question I have for you is, is it the maximization of stepping into the market with one foot on the dock, for example, and having some safety? Let me just throw those out. Conversation starter before we get into the heavy of today. What is it about these things we hear about called annuities?
No, absolutely. So your first question, the multi-year guaranteed annuity, is a fixed product. It's a fixed annuity. They're not dissimilar from your typical CD. They are not CDs. They're not FDIC insured. They're backed by the insurance company that you go with and their claims paying ability. But it's essentially a set time period and a set rate that's guaranteed throughout that time period. So in today's interest rate environment, even though we've seen a couple drops with the Fed, you still have some super attractive rates on the fixed model with these multi-year guarantees. 3 years guaranteed as high as 5.5%. And when you add in the benefit of tax deferral, there is tremendous opportunity for savers out there to get some guaranteed rates and defer taxes and use that. I call it triple compounding, right? Where you earn interest on your money, you earn interest on your interest, and you're also earning interest on the amount you would have spent on taxes. So if you look at tax equivalent yields versus non-taxable yields, the tax deferral is super powerful.
So back that up for a second, because it's so easy to hear about safe money running to to CDs. So you mentioned something earlier in your opening comments. The annuities aren't FDIC insured. In fact, some people, maybe novices, don't be embarrassed. There are a lot of people that have misconceptions about annuities. Annuities are insurance policies, sort of without the life insurance. We can talk about that at another time or possibly later today. But Scott, if you could verbally just maybe take 20 to 30 seconds and explain quickly the difference between what we find when we go to a CD that's paying 3.5% versus an annuity that, let's say, it's a multi-year guaranteed annuity that's paying that 5.5%. What are we winning and losing when we step into the annuity versus that CD?
That's a great way of putting it, as what are you winning or losing, because neither one is better, right? I think the key is to look at these different financial vehicles with the client in mind and what their goals are, right? With a CD, you're going to get things like FDIC insurance. You're going to get a little bit more liquidity. Typically, when you put money into a CD, you can cash it out anytime, and you just lose the interest. The other things is you have some really good banks, right? Bank of America, you have Chase Bank, you have some really strong banks that are offering some pretty good rates. What they don't offer is mainly the tax deferral. That's the huge gain that you're getting with an annuity, is the tax deferral. The durations, you can typically go a little shorter with CDs as well. There's some 3-month CDs, some 6-month CDs, and typically on the multi-year guarantee side, you're looking at about 2 years or longer. So the liquidity is the main thing, the tax deferral, and then as far as the FDIC insurance, there is a backing from the insurance companies, and they're all mandated, they're all regulated by each individual state, called the State Guarantee Fund, that has it's not dissimilar from the FDIC, but it's not FDIC. It's called the State Guarantee Fund, which guarantees a certain amount based on your state. If something happens and the carrier goes under, normally what we'll do is go with an A-rated carrier or better, and try to set that client's mind at ease with a strong insurance company.
Great. Well, Scott, that kind of sets the stage as we are going to analyze, we're going to dissect two different cases in living color right here on the screen. This is what happens when we meet a client. They say, hey, I have this old CD, or not old CD, old annuity, 10 years old, 5 years old. Things have changed quickly in this environment. And, besides us just stepping forward and going, well, we have something better, here are three choices for you. Let's show you the mechanics. Let's crawl under the hood. What we're going to do now is today we're going to analyze two cases, really seeing if we have a case for annuity refinancing. And you're going to hear me bring that up. Scott's going to talk about a little bit. Annuity refinancing. You heard about mortgage refinancing, but let's talk about annuity refinancing and what that means, and how we kind of establish, hey, this is a good opportunity for us to make a 1035 exchange from an old annuity over to a new annuity. So Scott, if you'd pull that up on your screen, we'll take a look at what you have there now as we get into analyzing this, and just hand the baton off to you, and you can start in on this for us.
Yeah, I appreciate it. And you said it. You hit the nail on the nail on the head. A lot has changed with the interest rate environment, and even though we're on a downward turn of the interest rate environment, when you look at the broad scheme of things over the last 20 years, it's still relatively high compared to what you've seen in years past. And especially with fixed annuities, a lot of the pricing is on whatever fixed interest rates happen to be. So a lot of times we'll get emails from other advisors, and they'll be looking for opportunities to better their client situations, whether that's with a multi-year guarantee, or in this circumstance, it was a fixed indexed annuity. So you can see on your screen here, we had an advisor. His name was Fred, emailed me at the beginning of this month. He's got a 78-year-old single woman in Arizona, and she's had this Allianz annuity for over 10 years, and she wants immediate income. And a lot of times when you look at these fixed index annuities, and they call them FIAs for short, there are two different values typically that you track. One is the account value, and that's how your annuity is performing. And that's your actual dollars that you can liquidate when the annuity surrender charge is up. And then there's something called an income rider value, or an income benefit, which is a set guarantee that the carrier gives you from an income standpoint, regardless of how the account value performs. So this particular one has been in force for over 10 years. And the income rider is going to generate right here $42,000 a year. And Fred wants to know, hey, is there anything better out there? Is there anything that's going to increase her income, because she's ready to retire and she's ready to spend this money and get an income stream for life? And so A lot of these income riders, they're going to give you some enhancements up front, and those enhancements are all different. And then based on that income rider value, they'll pay your client a set percentage based on their age. And that sum is what your client can expect year in and year out for the rest of their life, guaranteed, no matter what happens with their account value. So the question begs, how do you, with 20 plus carriers, and they all have riders and they all work a little bit differently, how can you pinpoint which particular one is going to be most advantageous for your client, especially when there's two moving parts, right? What enhancement are they giving me, and what percentage are they paying me when I'm ready to take income? So up on your screen now is a proprietary software that does exactly that. It takes all of the riders that are available, and it pinpoints based on the client data inputs that we put into the software, what carrier is going to pay your client the top dollar income based on their time horizon. And with this 78-year-old, it was income immediately. And generating the report will look something like this. So if it's your first time looking at this, it looks a little daunting, but it's a very digestible report when you look at the major things that this is telling us. So right here, what you'll get is a list of the carrier names. So you got American General and the name of the product, right? You'll also get the rating of the carrier. This is A rated with AM Best. Any sort of bonus that the carrier is paying would go here. Any roll-up rate, if you were deferring income, would go here. And this is the income account. So the income account is the 520 coming over. And this is your benefit rate that I mentioned to you. Now, this particular product that's coming up first is generating $57,000 a year. But oh, look here. In year 9, it decreases. And it's going to decrease to 31.2 and then pay 31.2 for the rest of your client's life. That might be okay for someone that's not in good health, but most clients don't want to see a pay cut. They want to see the income continue. So then you can go to the next carrier, Global Atlantic. They're A rated. They're giving you a 20% bonus on the rider to equate to 624,000, and they'll pay you a 7.7% income for life, which is 48,000. For someone that's looking for ultra security, they want a household name, we might even have to go down here to Nationwide, which is still in the top 5 in the industry on generating income. So Nationwide's a household name. They're rated A plus with AM Best. They're giving a 25% rider bonus, which would grow your 520 to 650. And again, these are day one numbers. They will pay you a 7.35% benefit rate, which equates to 47,775 for the rest of the client's life. And when you look at the increase that versus what's on the table at Allianz now, which is around 42,000, that's just about a 10% raise in terms of bottom dollar income year over year, every single year. So even though that current annuity had been in force for 10 years, we can put something in place tomorrow that's going to beat the income of the current annuity. That's the power and the strength of today's interest rate environment.
So, Scott, I want to jump in here. One of the things that if anyone is following annuities, the annuity world, and the things, the carrots at the end of the stick that some of the carriers are using, in a previous conversation we've talked about this. A couple of things that we want to continue to look for, and I'm interested in getting your insights on this as we discuss it, is this thing called bonus. The bonus, let's talk about what the bonus means. So that doesn't mean if you're moving a $500,000 in and you continue to get a 20% bonus every single year. There's a limit to that bonus. Let's talk about that, Scott.
Absolutely. So the bonus it's a one-time bonus. It's on first year premium for most products out there. And there's two types of bonuses to be aware of. One is a premium bonus, which you'll see here with Sentinel, and one is a rider bonus. So a premium bonus is on your actual dollars into the account value. So your 520 that comes over with Sentinel is going to be worth 572,000 to the account value and the rider value. The rider bonus is only credited to our rider benefit, our income benefit. So it's an enticement that the carrier gives to earn business. And with the law of large numbers, Nationwide and their actuaries have figured out a way to stay profitable and be able to pay clients these types of benefits based on today's interest rates environment. And a lot of the cases that we're working on are look like this, where something is, 5 years old, 6 years old, 10 years old. And even though it's performed well, again, the pricing is based on the rate environment at the time. So I think with a bonus, whether that's a premium bonus or a rider bonus, it can be a good way for clients that are looking for immediate income to beat what they currently have on the table.
Sure. Excellent. I love that. A quick question on that. Just stay on that screen for a second. What's better, a rider bonus or a premium bonus?
It depends. The premium bonus, typically what you see with a premium bonus is the caps and the upside potential that you have on that product are going to get a little lower because there's no such thing as a free lunch, right? They're giving you free
Right.
money. They're going to
Right.
limit the upside potential on the growth a little bit. A rider bonus, they're not giving you this $130,000, right? They're not putting that into your account. They're simply using that as a way to bolster your income account to get to this number. So I think bonuses can be fine on the premium bonus side if they're needed, and there are some really good uses for those that we'll talk about here on the next case. But I think for someone that's looking for income, it's cheaper for the carrier from a pricing standpoint to give a rider bonus, and typically what you'll see is the caps aren't really affected as much as that you would see on a premium bonus.
So let's stop there. Thing we learned here is if you're that person, you have an old annuity. It's a few years old. Let's say it's older than 5, 6 years old. Bonuses are available for you. There are other riders that we can talk about as we progress into this case. Things just have changed in this world of annuities so much so that it just is a financially beneficial move for you to consider refinancing because it's just going to be a more like doing double duty with your dollars. Scott, is there anything else? And with this particular case, I believe the client is 78 years old. So this could be somebody's mother. This could be somebody that's near and dear to you. Maybe you're not that person right now. Maybe you are that person, and everything counts now. Now you're what I'm going to call in the red zone, or you're in the end zone of your life, and you really would like to see progress with your money, with nothing going backwards. It's that important to you. Anything else we want to add as we study that worksheet in pertaining to case number 1 of 2 today?
Yeah, I will say that for someone that is in or near retirement, there's the term ROI that's thrown around a lot, and it's usually for accumulation, right? Return on investment, return on investment. For someone like this that's looking to trigger income that's not working anymore, I like to coin the phrase ROI as standing for reliability of income, where that particular switch in mindset is super important because the types of challenges that you're facing in retirement are vastly different than what you face in the accumulation phase of your financial journey. Things like inflation that you mentioned at the beginning of the call, people living longer, enhancements to medical breakthroughs. The other thing is sequence of return risk is huge as well. So annuities and the guaranteed income numbers that they pay out with highly rated carriers can be a great way to combat those challenges.
That's great, Scott. What we're going to do is jump on to case number 2. Let's take a look at that right now and kind of describe the difference between this case and the last one we just looked at as we dig into the worksheet.
Sure, absolutely. So this flipping the script over to a 63-year-old that's looking at not an income case, right? They're not ready to take income from their particular annuity. They're just still in the growth phase. So they might be working until, RMD age, which is, out at 73 or so. And they have a $205,000 balance in this FIA, this fixed index annuity, and the surrender value is 200,000. So your ears should perk up there. This is telling me that this current annuity is still in surrender, which the advisor is forthright with. And he's saying it's placed about 5 years ago. It's got 4 more years left. So it's an original 9 year surrender schedule that was purchased in the client's late 50s. And they're at a 6.5% cap. And I think if you look at uh, clients like this, a lot of times we don't like clients losing money, right? Especially in a fixed product. And if you're just to surrender this and go from 205 to 200, it's not a great feeling, right? So, is there a way to move this, get some sort of enticement for the client to keep them whole at the very least, and give them more upside potential than what they have currently with a 6.5 cap? And just to reiterate what a cap is the upside potential that an FIA will have. So for example, with a 6.5 cap, let's say the S&P 500 goes up 10% in a given year. This particular annuity would earn 6.5. Next year, if the S&P goes down 10%, this annuity would earn zero. So they're protected on the downside, and there's a cap in exchange for that protection on the upside. So at 6.5%, is there something else we can get into today that will give them a higher cap, higher upside potential, but they don't have to experience that pain of losing money to do it, right? Because if they just surrendered it outright, you're looking at 200,000. So we'll go right back into our trusty software. And just like what we did on the income side and looked at who's paying the highest bottom dollar income for a client, we'll do a search based on this client of 200,000. We'll look at only A plus companies, and we're going to look for something called a premium bonus, which we touched on in our previous case, where the carrier is going to actually give the client money into their account as soon as the funds come over from the other annuity as an enticement to earn the business. I also put in here a minimum cap. I wanted to see caps of at least 7.25 or better. Again, we're at a 6.5 cap in our current policy. We want to give the client a lot more upside potential to make it worthwhile for them to move the money.
Mm.
So what comes back are a few options, right? And it's the same kind of format. Our carriers on the left, we have our rating here of AM Best, the max issue age the product would take, the minimum premium that you have to put into to issue it, what type of premium they'll accept. So they take a one-time payment, or will they take additional payments, which is a flexible premium? What bonus are they paying? So this particular annuity with Athene is paying a 5% bonus. It does have a fee to consider, and the cap is 8.25. Now, what I like to share with clients is if they're experiencing no fees, I don't like to introduce a fee because we want to keep everything equal. We want to beat what the current cap is to give them the same type of scenario they have with more upside potential without introducing any more negatives into the plot. So we might have to go down here to National Life Group, which is checked here on your screen. And National Life Group, this Zenith product, again, National Life Group is A plus rated. They'll issue all the way up to age 75. They'll take a minimum of 25,000. The premium, they'll let you put in more money for the first year only, and then you're done making contributions. They will also give you a 5% bonus, so that 200,000 is now 210. So we've actually stepped up the balance for the client, and they're going to give you a cap of 9.25, which is 2.25% better than what their current annuity is paying. So the other things to consider on something like this is this 10-year time horizon still okay with the client? Because you are introducing a new surrender schedule for your clients. So you want to go over what that time horizon is for actually needing the money and actually needing to live off of it and produce maybe some income in retirement. And that was something the advisor had already done, right? They're looking to maybe tie it up for another 10 years. They don't need it until possible RMD age. So I think this is the first step that we look at to see if there's something else out there worth refinancing their current policy to get them, hey, an enticement on the front end and upside potential for subsequent years.
So maybe we have about 2 minutes I want to spend with you, and then we'll wrap things up. But Scott, Let's talk a little bit about something we talked about in a previous podcast conversation. Somebody just witnessed the analyzation, the dissection of how we go about picking the best in class for annuities when it comes to your particular case. What worked for you might not work for me or Scott or the person down the street. Let's talk about laddering. It's a strategy that has come up. There's various ways to insert that in the life insurance world and the annuity world. This might be a time for us to insert this subject of laddering. Let's say you're looking at the worksheet that Scott just showed us. And in particular, that first case where you saw that there was a larger payout, but a shorter period of time. And then we dialed it down and there was a shorter payout, a smaller payout, or for a much longer period of time. To me, what comes into play there is, Scott, maybe we think about splitting the dollar amount and putting it into two different types of similar but different annuities. I'm going to throw that at you. Please share, when I talk about laddering of annuities, what comes to your mind as a strategy to think about?
That's the next step, right? The first step we take is, hey, is it worthwhile to look at a possible alternative solution, which we've showed you on this screen here, the two cases in particular that we looked at, there is. The next step to that is, how can we get creative to really maximize that opportunity? And the laddering approach with the income is a fantastic idea. What you could do is, let's go back to that screen. What you could do is split between this particular policy and the nationwide policy. And what that would do for you is, let's say you can reduce this premium and still generate the 47,000 that nationwide produces for 9 years. What that would enable us to do is, whatever that sum happens to be, which is going to be less, right? It's going to be a lot less to generate 47,000 when the 520 is producing 57,000. So we would back into that number, and maybe it leaves an extra 150 on the table, right? That's not spent. And you could put that into a product like this that gives you some sort of rider bonus, gives you a roll-up rate because you can defer it now. And maybe you defer it for 9 years and try to make up that gap in 9 years using the power of tax deferral, using these guarantees that these products have. But it's not uncommon that we'll look at something like that to see if we can get creative to maximize every dollar.
Hey, that's great, Scott. We're going to have to wrap it up. This was the fastest 30 minutes that I've lived in my lifetime. I want people to start. Thank you so much, Scott White, for joining us, our annuity mastermind today. I want to go right to our final thoughts here. As we dig in today, I guess the questions when we look at my final thoughts are, do interest rates play into annuities today versus possibly 10 years ago? What do you think the answer is there? Do you have a fear of outliving your retirement income assets? And if so, are you sick and tired of having that fear? Is there another way to get into beneficial dollars that can do more than one thing for you? As we just saw, ways to do that without paying more. It doesn't hurt to look. Wouldn't it make sense to at least know? Do some annuities now address this with guarantees, bonuses, riders? You know, we're maybe 10 years older today and we've lived a couple experiences when it comes down to long-term care. Is there a long-term care rider we can insert into this? Things of those questions. And I think the other one is, what do the flux of market, not knowing the questions of what's going to happen in the market, due to our thoughts as far as safety is concerned, but yet we want to be aggressive and get into the market? Can we do both of those? Is there a possibility? Those are some of the things that we'll do. I want to drive you over to my website, joesimon.solutions. Go to the forms section. You'll see annuity refinancing and begin the worksheet process. And we'll generate this type of analysis for you today. But as we like to say, as it's time to go, have a prosperous day.
You've been listening to the Joe Simon Podcast. Big ideas with powerful stories and real-time solutions. Business succession planning, executive benefits, employee benefits, tax beneficial savings, and more. Remember, information discussed here today is dated and not specific to your situation. Always seek personal counsel from qualified advisors. Joe Simon is a licensed insurance agent in the state of Wisconsin, licensed to advise on accident and health, life insurance, disability insurance, and annuities, as well as qualified long-term care insurance.